Hello and welcome again to another episode of the Uranium Market Minute. Today is Tuesday, January 25th, and this is episode number 68. My name is Justin Hune. I'm your host and the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you for tuning in. Very exciting, very volatile, crazy couple of days in the uranium market and in the markets in general. Of course, before I get into it, as always, nothing in this video is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own choices. All right, what the heck is going on in the markets? Absolute volatility. Sentiment is nearing despondent, although it seems like it's turning around with the crazy day yesterday. Huge intraday swings in most stocks. I mean, let alone the uranium sector. We saw trillion-dollar companies have a 20% intraday swing yesterday, with massive selling in the beginning of the day, followed by kind of a realization seemingly across markets where, okay, this is getting stupid. It's time to buy this dip. And so far that is sticking today for the most part. Why is all of this happening? There is a Fed meeting, the FOMC, is happening tomorrow. That would be Wednesday, the 26th. And there are market concerns about the Fed Chair Jay Powell's potential hawkish tone concerning whether or not he will be confirming interest rate rises and the amount of those rises, etc. It's assumed that there will be an interest rate rise in March and that he will speak on that tomorrow. And so the market is trying to price in these expectations. And this is not something we are going to play the game of predicting. However, it does seem like if history is, if the past is prologue, what often happens is it's like buy the rumor, sell the news kind of thing, or opposite, sell the rumor, buy the news, where the market can freak out thinking, oh God, interest rate rises are coming. And then, the Fed chair will come in and say, oh, it's going to be 25 basis points in March. And we'll see about, the next raise. And then the market goes, oh, okay, well, I think we can live with that. And it seems like the general trend tends to resume. And looking at the market trading action yesterday, it seems possible that that is what is happening here. The selling yesterday seemed to be way overdone in the uranium sector as well. So we saw some really big sell-offs early part of the day, followed by many of the stocks ending green for the day after being down 10, 15% in early morning trading. Just astonishing volatility, breathtaking. Yesterday was a very exciting day, and I did not do a market minute. My apologies. We were communicating with our members via a bulletin that went out in the late morning, kind of saying what we think we're seeing in the markets and what we're expecting going forward. So it looks like things are starting to stabilize a little bit, and that's good. But before we go ahead and look at the charts, let's jump into the daily scoreboard here. Not a lot of action happening in the spot market, although the trading volume continues to be pretty robust with the Sprott Physical Uranium Trust, SPUT, still largely or almost entirely out of the spot market currently. Seems like there's a lot of trader churn going on that's taking advantage of their absence. So we're seeing the spot market, the spot price tick down slightly. We're at 44.37 a pound mid-market. That's just a couple dollars below where it was sitting about a week and a half ago after the price jumped up on the initial Kazakhstan unrest news. We're still up over $2 since the beginning of the year. That's a good sign. Over the last 2 trading days, SPUT did not raise any new capital, nor did they buy any uranium. These numbers are coming in as far as SPUT and the ETFs for 2 days, since I was not here yesterday. So that'll be Friday and Monday. We do now, though, officially have confirmation that SPUT is going to be included into URA. That's a really big deal. I've spoken briefly on that in the past market minutes, but this is something that even a month ago, nobody was hopeful for that inclusion based on the communications that Sprott CEO John Ciampaglia had with the Solactive team that manages URA, based on the fact that URA did not seem to be interested in changing their rules in terms of holding foreign trusts. Now they have changed that language the past few weeks and confirmed SPUT is being added. We expect somewhere between a 7 and 10% allocation, 10% being the cap of what they're willing to allocate towards a trust that they would hold. So, obviously long term, that's a very, very good sign. That means more flows, more passive flows that's coming into the ETFs, going into spot, leading to physical purchases. In the short term, that means they're going to have to sell down some of their other underlying holdings to make room for spot. Now, I did mention in the previous market minute that they're divesting of their holding of BHP. That was a $20 million position. So that helps with this rebalance in terms of the pain that will come from selling underlying holdings. Now, we do believe that that selling has already started, but they have a little ways to go. In fact, they can actually participate in this rebalance. They can act on this rebalance in terms of their buying and selling until the 7th of February. If they're smart, they spread it out a bit and not wait to the last day and hammer these things. But that's yet to be seen. So we expect a little bit, still some weakness going forward. Whether that's further downside, that'll remain to be seen. Whether it's just sideways chop based on some selling flows coming from URA's rebalance, we'll have to see. The ETFs going into, so Sprott, basically just to put a cap on that, they closed yesterday at a substantial 4.73% discount to NAV. They're sitting on 23 million in cash. They're likely not to spend any more of that money on physical purchases until they can raise more cash. The trust is up about 1% of the day today, still likely not close enough to being at a premium to NAV, sufficient to raise more cash. So they've raised over 1.1 billion of new capital total since last August, purchased. They now hold a total of 44 million pounds of uranium. 2.7 million pounds they purchased year to date and raised 122 million. So though they've been quiet this past week, they came in strong this first couple of weeks. So looking at the ETFs, despite the market's turmoil and weakness in the sector, URA reported no decrease in shares outstanding on Friday or yesterday. Will they have a further lag and report a decrease tomorrow? We'll have to wait and see. URNM reported a slight decline of 25,000 shares. That led to mandated selling of minus $1.6 million, really a drop in the bucket, all things considered. This is just remarkable that the combined outstanding share counts of these two ETFs still remains at almost all-time highs, considering that the sector has now sold off. Well, it's rebounded a little bit end of the day yesterday and today, but still we're looking at 40 to 45% for most equities since the November high, and the ETF shares have risen, now almost at all-time highs. So as we've been saying, it's not money coming from share redemptions in the ETFs that's leading to the selling pressure in the uranium sector. That selling pressure is coming from possibly margin calls from other holdings. That's coming from retail. I mean, the retail sentiment is in the doldrums here. It's very, very bad. And sentiment is often an indicator. Very negative sentiment is an indicator of a bottom. Typically, euphoric sentiment is an indicator of the top. So we believe that or it's not that we believe it, we know that the selling is not coming from ETF redemptions. It's not. So seeing that the share counts are there, what seems to be happening is there's smart money positioning in these ETFs on this weakness, while retail sells down the shares. I mean, it's probably some institutional selling as well, coming from, like I mentioned, just a general risk off environment. And when you go risk off in the broad markets, it affects everything. It affects every asset. Now, some sectors have held up better. Oil has held up better. Gold and silver is finally trying to kind of stabilize here, and actually has been doing decent in the past month or so. So we're seeing a bit of stabilization in a couple of sectors, but for the most part, when you have an extreme risk off event like we saw yesterday morning, like we saw a bit on Friday going into the weekend, in expectations, going up to this FOMC meeting, risk off affects everything. Crypto got hammered. Risk off means wherever you have risk at play, it's time to pull some of that off and protect capital. And that's what people do. And it affects everything. So it's not unique to uranium. And that's what we've been seeing the past few days and the past couple of weeks to a certain extent. So I spoke about this more in depth on Friday, but I really think that this is an important observation with the ETF outstanding shares. I mean, this is not institutions bailing out of their positions. In fact, they're adding here. They're adding to the ETF. So that's just really interesting to me. And I think it's very noteworthy to consider the flows coming into the ETFs despite the abhorrent sentiment amongst retail. So that's very curious. Let's see here. So since January 1, URA's outstanding shares have increased by 3.5 million, URNM by 675,000. That's mandated buying from the ETFs, 116 million. That's crazy. So the mandated buying coming from the ETFs is essentially buying the shares that we all have been selling. When I say we, I'm not including myself. I haven't been selling at all. In fact, quite the opposite. But very curious that the ETFs they've been adding. So they've been buying shares that retail's selling down. Huh, interesting. The combined AUMs of the two largest ETFs, URA and URNM, has fallen sharply in line with the sector sell-off, now sits just over 1.8 billion. We continue to expect cross currents in the sector over the next couple of weeks because of this URA rebalance. So we're going to see how it sorts itself out based on that expected 7 to 10% inclusion in the URA of SPUT. All right, so let's take a look at the charts. URA with just about an hour of trading left in the day, printing a hammer after a really crazy hammer yesterday on big volume. Volume tapering off a bit here. It does look like it's stabilizing. I'm happy to see that the gains, the small gains yesterday are relatively stable here. In fact, it is flat on the day. So I'm happy to see that people are not bailing out further on this and that there's some more dip buying that happened today. Either way, this chart is still short-term bearish. Like I mentioned, positive divergence in the RSI is completely lost. MACD still turning down, starting to flatten a little bit here. Volume diminishing besides the last couple of days, but we've obviously completely lost the 200-day moving average. It's starting to flatten. In fact, if that turns down and the 50-day drops below it, that's pretty darn bearish signal. Hopefully we don't end up seeing that. Would like to see the sector stabilize here. We'll have to see how it goes moving forward. Sprott Physical Uranium Trust also up, moving up nicely in the later trading, 2.57% on the day, still probably right around a minus 1% discount to NAV, although if the spot market did slip a bit today, which I believe it did, maybe we're getting closer to NAV here. Either way, not much to write home about in terms of volume. Not expecting there to be a big volume ramp here. In fact, I don't expect much until the market sorts itself out with two things. The FOMC, the market has to digest the information that comes out tomorrow from that meeting. That may take a minute. That might take a couple of days. It might take a couple of weeks. We'll have to see. If the market thinks that the signaling from the FOMC tomorrow is overly hawkish and therefore bearish for markets, then it's going to take a little bit longer for that to settle out. We could see more weakness. If the signaling from the FOMC comes in more dovish, and the market is probably going to move up and rejoin that previous uptrend because of the selling that has happened going forward into the meeting, it probably will reverse and stabilize and move up. And we expect that uranium will likely follow suit considering the selling that's happening. Either way, nice to see a good day here for the Sprott Physical Uranium Trust. Similar to URA chart here with Cameco, has not sold off quite as steep. In fact, Cameco has held up better than many in the sector for the most part. We just got word that there was another buy signal for Cameco coming from Larry McDonald from Bear Traps report that came out yesterday, I believe. So I'm seeing a little bit of support here, but volume clearly not raging back into these stocks or into the sector. Like I said, we're going to need the FOMC information to digest in the markets. And obviously for uranium, you know, we're going to want to see some action into the Sprott Physical Uranium Trust. We're going to want to see some action in the spot market. And that's really what's going to move the sector up. So until that happens, we're likely to see some recovery due to the extreme selling that we've experienced. But at the same time, I don't think we're going to see a rocket ship to the moon unless and until we see the spot price move. And I honestly don't expect that in the short term. So this continues to be accumulation mode, in my personal opinion, and leading up towards that URNM takeover by Sprott, becoming the Sprott Uranium Miners ETF in late February, and of course the NYSE listing that we expect in Q3. So let's look at the mailbag. I did get a couple of questions and comments about on Twitter having to do with previous examples of this type of volatility in the uranium market. So I'd like to share my screen and show you guys a interesting chart that was shared by Yellow Metal on Twitter. So this comes from @YellowMetal on Twitter. I thought this was a really insightful tweet. Revisiting Paladin, PDN, and famous 2004 to 2007 rise from cents to $10 before it fell from the sky. As most of you are probably aware, this is one of the big winners from the previous bull market. It literally was trading at a penny, I believe, in 2003. And it ended up getting almost to $10 in that rise. So, and Rick Rule famously made a lot of money on this trade, as did many others. No less than 9 times did holders endure a 30 to 50% drawdown every 2 to 6 months from the bottom to the peak. And that's in the course of 3 years. 9 pullbacks greater than 30%. In fact, zooming in on the Paladin chart, which we're not going to do, but if you zoom in on that first pullback that happened 2004, that pullback was almost 60%. So it was like the beginning of the bull market, and the first big pullback probably shook damn near everybody out. 60% pullback. Okay. And that doesn't mean you necessarily have to hold through all of this, but obviously the big money is made in the waiting. It's made in the sitting. And so I like the comment at the end of this. Uranium is not a knitting class. That's for damn sure. This is what you mentally sign up for if you want asymmetrical returns. So you cannot have asymmetry to the upside without extreme volatility to the downside. You can't have one without the other. It just doesn't happen. If you want a safe, stable investment, just go buy bonds and don't even mess with stocks. All right, put your money in cash, buy a CD. The stock market in general is volatile, and you're stepping up. If you mess with gold and silver, oil and gas, cryptocurrency, uranium, there's a number of other sectors that are equally as volatile, but uranium is up there with the most volatile sectors you can possibly expose yourself to. So if you want to if you want to have that upside and these famous stories, oh, we made 25 to 50x on that investment, you're just not going to get that unless you have the risk. I mean, this goes for anything really, like anything in life. It's like you don't make great rewards without great risk. And that's what this is all about. So this has obviously been a very painful, long, this is a 2-month pullback at this point that we did expect to not go this deep or be this steep. And, I'll be the first one to admit that we expected more strength, and we started to see that at the beginning of the year. But, obviously the broad markets will have their influence, especially when the spot market is flat. So we are back into accumulation mode, and there's absolutely nothing shaking us out of this in the mid to long term. Nothing at all. In fact, we are very aggressive here. I was, direct messaging some friends on Twitter yesterday, basically just saying like, man, I haven't felt this greedy in a long time. Yesterday, actually, I woke up expecting to be very stressed out and seeing futures were down and expecting it to be a crazy day, and it was far crazier than I had even expected. But I didn't feel the stress from it somehow. I felt like I had a mission, and the mission was to accumulate. And so I did that relatively aggressively yesterday, and we'll see if that, turns out to be a wise thing to do in the long term. I mean, in the long term, I'm almost guaranteed that was a strong move to position as much as I could. But in the short term, we'll have to see. I mean, we could see more weakness going forward. Either way, long story short, volatility is the name of the game. So if these moves and if these pullbacks are really, really stressing you out, like I've said before, you likely have too large positions. Your positions are too large, and you should trim them. You really should. I mean, that's not investment advice, but that's what I would do. If I'm being kept up at night by the swings in my portfolio, then I'm overexposed. I should take some money off and hold it in cash or invest in something less volatile that I feel that is a safer investment. But for me, it's just I thrive on this volatility. I love it. I love seeing these swings, and this is what it's all about, because I know you have to be able to deal with this, and if you want that upside potential. I wanted to share one more image. I don't remember who shared this with me, but this was Denison Mines chart from an FOMC meeting and a rate hike. Let's see. This is back in 2004, if I recall correctly. Either way, you could see this 55% decline in Denison Mines during this period of time, right before the first FOMC, before the first rate hike of this period of time. Okay, so it declined. Look, I mean, this is almost identical to what we just witnessed. Look at this decline. Like the November pullback, it started to kind of recover. Then we saw further pullbacks into December, into January. Now it dropped a little bit more steeply. And in 2 green days right before the FOMC, and that's exactly what we're seeing here. And then they actually hiked, and we kept moving up. Now, of course, this is in a backdrop of a rising price environment for the spot price of uranium. I just thought that was a really interesting correlation. That the rate hikes and the FOMC talk is not the only thing that drives these markets. So, but lacking the movement in the spot price currently and lacking flows into spot, especially, we are more beholden to the broad market, movement. So that's kind of where we're at, and we'll see how things shake out tomorrow. I'm hopeful that the Fed pulls back on the hawkish talk, based on volatility that the expectations of raises has had an influence on these markets. So we'll have to see. So we'll be watching that tomorrow. All right. Hope you all are having a good day, and we'll see you tomorrow. Cheers.